Hello and welcome to this week's podcast, brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services, forex, stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me again is Pepperstone Senior Market Strategist Michael Brown, fresh off the back of another press conference from our friend Christine Lagarde, President of the European Central Bank, and on the back of another 25 basis point rate cut. We'll talk about that in a minute, but first and foremost, I think what we're going to need to discuss, Michael, is obviously a whole array of things since we spoke 2 weeks ago, starting with the Trump effect, because obviously I think our friend in the White House has, I think, really driven quite an awful lot of the news narrative over the past couple of weeks. But what it's also done is I think it's also shifted the narrative here in Europe towards a significant fiscal boost when it comes to defence spending. So we're going to talk about that. Talk about the divergence in US markets, which are now down on the year. As I look, the S&P is down, the Nasdaq is down, the Dow is down. They're all in negative territory for the year. Contrasting that with the DAX and the FTSE 100, which are doing fairly well. But of course, I think they're outliers, aren't they? And I think when we look at them, I think there's certainly a premium there when it comes to defence. Certainly that's helping the DAX. To a lesser extent, it's helping the FTSE. But the FTSE 250 is down, the FTSE mid-cap is down, and obviously bond yields are on the up. So before we get into the guts of it and the risk warning, do you have any sort of, short summation of perhaps why we are where we are at the moment?
Yeah, well, firstly, very good afternoon to you. I'm not sure fresh out of the ECB is the way I would put it, but I'm here nonetheless. I think in short, it is a growth scare. The market has become very worried very quickly that the figures we're getting out of the States are deteriorating quite rapidly. And I think compounding that is an extremely high level of government policy uncertainty. And also it's not being helped by the fact that actually the Trump administration are by and large doubling down on the hawkishness, whether it be on trade or geopolitics or really any subject. So it's a bit of a sort of perfect storm facing financial markets at the moment, I think.
Yep. Okay. So on that score, this is essentially what we're going to be discussing over the course of the next 30 to 45 minutes. Obviously, we'll look at a number of companies. We'll go back to that piece that we did on defence 2 weeks ago. I think that was quite timely, as it turns out, Michael, given the performance of all of those companies that we mentioned. We're going to have a look back at Nvidia as well, I think, in the context of a decent set of numbers. And also look at the problems, I think, with respect to how Germany's politicians will try and get round the so-called debt brake, which could actually stymie the defence plans. But before we get started, I have to do the risk warning. So here we go, albeit 3.5 minutes in. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own financial advice. Spread bets and CFDs are complex financial instruments and come with a high risk of losing money rapidly due to leverage. 75.9% of retail investors lose money when trading spread bets and CFDs with this provider. Okay, so where should we start?
Where do you start with a fortnight like we've had with so many developments, not only from a fundamental perspective, but also from a financial markets perspective? I mean, we're at risk of doing a 2-hour-long podcast if we go into all of it.
We are. I think we have to define a narrative here, and I think there's a tendency to define a narrative when it comes to market moves. And obviously I think there's an awful lot of fear out there. There's an awful lot of anxiety out there. But I think when you actually break it down, FTSE 100's made new record highs, DAX has made record highs. To listen to the mainstream media, US markets are in meltdown. 2 successive weeks of losses. But I'm looking at my S&P 500 chart now, and it's still above its 200-day moving average. So is the Nasdaq. It's still above those lows that we saw back in November 2024. So we're not in a full-scale meltdown. And I think sometimes,
not at all.
I think there's a tendency to, I think, what I would call over-dramatize what's going on. And I think that does have a tendency to spook smaller investors. Now, I would say to you, there are plenty of things to be worried about when it comes to recent political events and economic events. And certainly Donald Trump's behaviour doesn't really give anyone a degree of confidence that he knows what he's doing. Or maybe he does. Maybe there's a grand plan at play.
Well,
but looking at the markets now, the dollar's sunk, yields are up, and the S&P, the Nasdaq and US markets are testing their 200-day moving average. But we're not going to panic yet.
No, absolutely not. And I think, context is pivotal. And, again, zoom out. We are, I think in the S&P, I was looking earlier, about 6% off the record highs that we set in mid-Feb. It's not a calamity. It's not a catastrophe. I think probably the biggest sort of landmark, if you like, that we've hit this week in a market sense is that the S&P is now, actually at the time of us doing this recording, below the level it was at before Trump was elected last November. And I think that's important from a psychological perspective, because that now means the media can run around going, stocks are down under Trump. Now, I think you mentioned Trump, does he have some sort of grand plan? I'm not going to pretend to know what his plan is, because I don't think he does. But there is an argument that says that the whole sort of overarching strategy of the government at the moment is one of short-term pain for long-term, or what they would perceive as long-term gain, like, for example, evening out trade relationships, like the Department of Government Efficiency trying to strip out waste in the federal government. And what's been very, very interesting for me over the last couple of weeks, and because there's been so much going on, it has gone a little bit under the radar, but we've had both the Treasury Secretary, Scott Bessent, and the Commerce Secretary, Howard Lutnick, effectively talking down the US economy. Bessent was talking about how the economy is brittle under the surface, and Howard Lutnick was calling it lousy yesterday and effectively trying to blame everything on Joe Biden. And I think this is important because people in those roles...
That sounds familiar. Because
Because
the Labour government did that when they came to power in July.
Exactly.
But go on.
Well, what I was going to say is that you're exactly right. And people in those positions do not generally talk down their own economy. And it feels like what those two were doing was effectively rolling the pitch for a slowdown to then say, hang on, guys, if there is a slowdown, it's not our fault. It's the other guy. We're the good guys. We're here to fix it, and to then take credit for the eventual rebound, even when that does take place. So that could be the grand plan. I'm not sure.
Yeah, well, it seems a rather strange way of doing it, because obviously the new government here in the UK tried that, and look at where we are now, and obviously we've had the budget, and yields are now back where they were in early January. There was a brief respite, I think, in February while I was away in the US. And certainly when I was in the US, the economy there didn't give me the impression of being particularly brittle. And when you've got an unemployment rate of 4% and you've got weekly jobless claims in and around 230, 240, again, that doesn't sound to me a particularly brittle economy. So they need to be very, very careful about what they wish for, I think, because as Rachel Reeves has found out, when you undermine confidence to the point where consumer confidence takes a hit, it's very hard to get that back.
Yeah, absolutely. And we have seen confidence, business confidence, consumer confidence, and ultimately financial market confidence has been falling considerably over the last couple of weeks. And I think it's a combination of two things. You've not only got the policies themselves, in terms of tariffs, in terms of government spending cuts, etc., etc., etc. You've got the uncertainty associated with those policies as well, which is making it, if you are a consumer or if you are a business, it's making it next to impossible to plan in the long term because policies are changing with 12 hours notice. And from a financial market perspective, if you're sat there as a trader or an investor, it's almost impossible to be trying to discount the future path of policy and have a concrete idea of how that landscape will lie, because even the bloke in charge doesn't seem to have that concrete idea. So it is logical that market participants have sought to de-risk, come out of equities, but also actually come out of US dollar denominated assets. You mentioned the dollar having fallen significantly, the relative outperformance that we've seen in Europe. So when you sort of cut away some of the noise, and all these sort of doomsayers saying the end is nigh, the market moves do make a degree of logical sense when you take a bit of a step back.
Yeah, I mean, I think we sort of talked about it a little bit. I think when we talked about Warren Buffett and Berkshire Hathaway,
Mm.
you de-risk some of your more high beta investments. Now, a high beta essentially is big tech. It's very frothy in terms of valuation. And if you're worried about a potential stock market pullback, then you pare down the size of those big tech positions to lock in a little bit of profit in the event you do get a significant correction. And I think that is part and parcel of what we're probably seeing on a slightly smaller scale to what we were seeing with Berkshire Hathaway and Warren Buffett's summing up of the economic outlook when he did his little his little speech, I think just over 2 weeks ago. So
Yeah.
it makes perfect sense. I think in terms of what we've seen, US markets have really outperformed over the course of the past 4 or 5 years. Now there's potential for them to underperform. Now that doesn't necessarily mean they're going to fall off a cliff, but when you've come off 2 or 3 years of 20+% gains year
Yeah.
on year, that's not going to continue forever.
No, absolutely, and I would agree with you. I think the path of least resistance, so to speak, is still one over the longer term that will lead higher, but it will just be a much shallower path on Wall Street than we have had in 2023 and 2024, when we had these 20 odd percent gains. And I think the other thing, just kind of again looking forward, is the degree of policy uncertainty is not going to dissipate anytime soon. It's in the States in particular. The start of April is the big period to watch, because that's when these reciprocal tariffs are potentially going to go into place, and that is when you actually start to think more about the macro effects of the trade war, as opposed to them being a political tool and essentially a negotiating gambit. So the story on the tariff front and on the uncertainty front is not going to change. And as we move forward and time progresses, growth expectations will be brought lower, corporate earnings expectations will be re-rated lower, and you would expect there to be a degree of turbulence that persists for a relatively long period of time.
And I think we're seeing the effects of that this week. Now, you mentioned about policy uncertainty, and obviously you just finished listening to Christine Lagarde at the ECB, and I know you're not a big fan, and I have to say I'm not a big fan of her either, but in her defence, some of what she said made perfect sense in the context of, given current uncertainties, it's very difficult for central banks to give a steer one way or the other as to whether or not we're going to get further rate cuts. How many further rate cuts are we going to get? Have we reached the bottom when it comes to further rate cuts? And potentially, could the next move in rates be higher? Certainly in terms of the uncertainty principle going forward, it's very difficult to model that.
No, you're absolutely right. I mean, I'm not going to have too much pity for these central bankers. They are on big enough salaries and got enough teams of PhD economists around them to be able to have at least half an idea of what's going on.
Sorry,
But you
sorry,
are,
where have you been for the last 15, 20 years?
well, yeah, good point. But no, you are right. There is a huge degree of policy uncertainty, and it does make it very difficult for other policymakers or even other market participants to adjust to exactly what's going on. I think in terms of the ECB, though,
I think they're
obviously
done.
that's wasn't what I was going to say, but
No,
I'm
but
going to let you explain that, Cole,
I
now.
think they're probably done because well, you obviously have a different view. ECB headline rate is 2% below UK and US base rates. It's 2.5%. UK and US rates are 4.5. How much lower can they go if, and it's a big if, this debt brake in Germany gets relaxed and the Germans unleash 500 billion euros of fiscal stimulus. The EU is talking about 800 billion euros. Well, 500 billion euros of that is going to be Germany. We're seeing that play out in the defence sector. Now, obviously, the proof of the pudding will be in the eating. Will they get it through the German Parliament? There's a vote on the 18th of March. I've already seen evidence that inflation has bottomed. Do you really want to be cutting rates at a time when you're seeing price pressures start to tick higher? That's my argument.
I agree. I agree. But I would also say that I don't think inflation has bottomed. Let me just clarify that. I also think that the growth outlook in the Eurozone is so utterly dire still. Even though
Stagflation.
potentially, although I think, dare I say, I believe the ECB's inflation forecasts, but I think the risks in the Eurozone are probably more in favour of an undershoot than they are a sustained overshoot of the 2% target because the growth side of the economy is doing so utterly terribly.
At the
And
moment, but
at
it's
the
got to be,
moment,
forward looking, right?
I agree. I don't think a huge amount of, yes, defence spending is clearly
Mm.
needed. I don't think it's a game changer that's a silver bullet to solve all of the ills of the
No.
German economy or the Eurozone economy. So yeah, I do think the ECB are going to continue to reduce rates just at a slower pace,
How
which
many more this year?
I two or three, two or three more this year.
You're going to get splinters on your backside, mate.
If you put a gun to my head, I would say that they now just deliver cuts at the forecast meetings. So
June,
that would
September,
be
and
June,
December.
September, and December.
Right.
But again, that is, it brings us on to a broader point
Mm.
whereby central banks around the world are basically trying to get rates from high to neutral. And
Mm.
no one knows exactly where neutral is. The ECB reckon that it's anywhere between 1.75 and 2.5%. Now, it's natural for policymakers to slow the pace of policy easing as they get nearer to that neutral rate because it's one of those concepts that is very, very fuzzy, but also you only really know when where neutral is when you get there. So the last thing a central bank wants to be doing right now is, cutting say 50 basis points a meeting, and then all of a sudden go, oh, we might have gone too far, and the inflation genie is back out the bottle again.
It's a big gap, though. Mind the gap for the neutral rate, 75 basis point window,
Yeah, if
175,
that's
250.
the tightest spread they can get it to, they
Yeah,
might need to build a better model, I think.
I
But
think so. Okay, so let's move the conversation slightly away from obviously Germany and Europe. So basically, I think as far as Europe is concerned, I think the key things to watch out for now are obviously the debt brake negotiations. Will the German political parties, in the time that they have before they have to dissolve the old parliament and get the new parliament, will they be able to make the 2/3 majority that they need to get the debt brake legislation passed? Now, I was speaking to Helen Thomas at Blonde Money. I tweeted her the other, and she seems to think they would.
I mean, Helen knows a hell of a lot more about this sort of thing than I
Yeah,
do, and I will defer to her expertise on that one. I guess this is probably a case of
it's a
the
game changer if they
situation is
do.
so, it is a game changer, but I think the situation is so severe and so urgent, given what's going on the other side of the Atlantic,
They have to
that
do
it
it.
probably will force their
Mm,
hand and force them to act. Um, the market, though, has reacted quite adversely.
mm,
Particularly if you look at the 10-year bund yield. I mean, Wednesday, the 10-year bund rose 30 basis points, which is the biggest one-day rise since just after the Berlin Wall fell,
mm,
to put that into a little bit of context. Because, fine, you want to spend 500 billion on additional defence spending. Well, firstly, that's above what had been reported previously. I think previous reports were that it was going to be about 200 billion. But secondly, where the hell are you going to get the money from? Because you're not going to raise taxes to fund this, and you're
mm,
not going to cut spending enough to fund all of it. So you've got to go to the market and you've got to get some bonds sold somehow.
mm. And there's a lot of supply out there this year. I think French government
Hmm.
bonds, I think they've got to refinance 330 billion euros, and that's before they even factor in the additional new defence spending that they're looking to do. Germany's fiscal position is slightly better, though. I think their debt to GDP ratio is 60% of GDP, 65. But also, yes, we've seen a big move in the German 10-year, but we're only back to the levels we were in October. Well, we're back to the levels we were in October 2023. So
Yeah, we're not actually above 3%
we're
yet,
not
are we,
above
to be fair?
3%
So
yet. So I think if we go back above 3%, that's a a whole different ball game.
yeah.
I think it's affordable for Germany because they are essentially a fairly low debt
Hmm.
when it comes to, but there are also an awful lot of other off balance sheet things that perhaps don't show up in those numbers.
Yeah, and also there's a lot of well, they're even going to create a special fund for this defence spending to try and
Yeah.
sort of circumvent the whole debt brake kind of shenanigans. I think what's interesting though is that since Germany came out with that announcement that they are going to deliver this boost to defence spending. We've also seen a big spillover impact, not only onto other EGBs, but also if you look at gilts,
Mm.
gilt yields have torn higher as well on the back of this. And of course, that poses a problem for Rachel Reeves. We've got the spring statement at the back end of the month. And again, the market is eroding or has eroded the Chancellor's fiscal headroom and her room to manoeuvre.
And this explains, I think, the weakness that we've seen in the FTSE 250 and the FTSE small caps. And in the context of a question we received during the week from an ex-follower, just being honest here, I think that is one of the reasons why the smaller cap UK stocks have underperformed, because
Mm.
ultimately the UK economic outlook is not particularly great. Now, there's an awful lot of pessimism around the outlook for the UK, quite justifiably. We've got the government here talking about increased defence spending for helping Ukraine out and what have you. But where's the money coming from? It's all very well basically cutting winter fuel payments for pensioners, but then they find another few £1 billion down the back of the sofa for Ukraine. They find
Mm.
another few £1 billion with respect to the Chagos deal. I mean, and it's all about priorities. So there needs to be a rethink, I think, in terms of government policy around existing budgetary, constraints, particularly around, say, for example, welfare, around the NHS. They need to run it more, and around net zero.
Yeah, no, you're
They
you're
need
absolutely
to
right.
tear net zero up. You cannot rebuild your defence industry if your electricity is the most expensive in Europe, if not the G7.
Well, I was going to say it's probably getting on for being the most expensive
Expensive in the world.
in the world, and also not only that, but also if you get to a point where we're paying through the roof for our electricity, but if Mr. Miliband gets his way, and I don't want this to become political, we could be at a stage in literally 5 years where if the sun isn't out and if the wind isn't blowing, well, good luck turning a light on.
Well, I've been saying that for years.
Hmm.
I mean, I think a lot of people have been saying that for years, but it doesn't appear to be cutting through.
No, it
Um,
doesn't at all, and it is worrying. Because Rachel Reeves' options at the end of the month are very, very limited because she's boxed herself into this corner ultimately. But, okay, fine. We get the spring statement. The OBR's outlook is grim. We have more government spending cuts to try and restore a degree of fiscal headroom. Great. But what happens when 10-year gilts sell off another 50 basis points by the time we get to the budget in the autumn? You can only cut so much in terms of spending. And it's great that the government are running around saying we're going for growth. But the policies that are being enacted are not conducive to engineering solid economic growth and a significant uptick in economic output. And against that backdrop, as you said, why would you want to be buying small or mid-cap equities in the UK? It just doesn't. It's not an attractive risk reward. But obviously, the FTSE 100 is somewhat immune to that, given its huge international exposure of the members of the index.
Yeah, and we've said this on a number of occasions. The FTSE 100 is not the UK economy. The stock market is not the economy. It's an amalgamation of different stocks covering different sectors, some of which will do well and some of which won't. And the market is cyclical. And ultimately, based on the weightings of any particular index, you've got what I would call survivorship bias. So all stock indices should generally outperform because there's a survivorship bias involved in terms of the makeup of those indices.
Yeah, no, you're absolutely right. Hit the nail on the head, man.
Okay, so we've sort of covered that. What we didn't mention, and I think this is something that we do need to bear in mind when it comes to obviously the US economy, we've got non-farm payrolls on Friday.
Yes.
At the moment, there's no evidence that hiring is slowing, though there have been some anecdotal surveys saying that US companies are now starting to shed jobs. But we've also got the US government shutdown on the 14th of March, where we could see lots of furloughs of government and federal employees as the US government, to save money, basically lays off a whole load of its staff. And that could start to be reflected in the US economic output in the first half of this year. So it'd be interesting to see how Musk, Vice President Musk, and the Doge get involved in basically whether or not they avert a shutdown and come to a bipartisan agreement, or whether or not it goes ahead, and if it does go ahead, how long it lasts. So that's March the 14th. Yeah. So that's something that's sort of flown under the radar a little bit, I think, in the because it's been drowned out by all the other headlines, but it's still a factor nonetheless.
No, absolutely. And I'm going to say this anyway. It may age terribly because people are going to see the jobs numbers about 2 hours after this podcast comes out, and this could age like milk. But I think that the March jobs report is the important one, rather than the February one, because the February figures that we get, well, today when you listen to this on Friday, the survey week for those figures was before the vast majority of these government layoffs were actually enacted. It was before we started to see markets take a turn, and before we started to see a lot of these tariff measures and other measures of confidence fall off a cliff. So I think the March jobs figures are likely to show that impact much, much more acutely. That said, I think we are at a point now where we've gone from the US labour market being very, very resilient and shock-proof to now being considerably more fragile. And actually, I think that the risks around the labour market are significant because, as you said, not only have we got Musk running around sacking half the government, businesses in the United States, given the prevailing level of uncertainty, will be much more reluctant to hire new employees, given the huge amount of uncertainty that there is on the outlook. So you've got, both sides of the equation where headwinds are likely to grow over the next quarter or so.
And we've already started to see that here in the UK. I mean, there was a construction PMI number out earlier today, and that made for very, very worrying reading. The construction PMI collapsed from 49.8 to 44 point something or other. And what was more worrying about that was that actually input prices went up.
Yes, and actually you started to see that in the United States this week as well, in the ISM.
Prices paid.
Yeah, both the manufacturing and the services metrics, prices paid through the roof. Now, I think that in the manufacturing number in particular, there may be a bit of a skew because a lot of companies in the United States are trying to front run tariffs and surging imports as a result, which probably is pushing price a little bit higher.
So they
But if
bid
that becomes
prices
a
up.
trend, if it becomes a trend and then you throw a 20% levy on top, things start to get a bit ugly a bit quickly.
Yeah, so basically Canada 25% tariffs, Mexico 25% tariffs, though autos have been delayed for a month, and China an additional 20% tariffs on top of the tariffs that were already on Chinese goods.
Yeah, and then we've got, as we mentioned earlier in April, we've got the reciprocal tariffs, we've got autos, we've got metals, copper, chips, God knows whatever else.
So, yeah, I mean, basically, you're talking an awful lot of what I would call noise and political and economic uncertainty, a lot of noise, and ultimately that makes for a very difficult investing environment. But thus far, while yields have edged up, I think the key takeaway for me is there's no need to panic quite yet, because what we're seeing at the moment is a little bit of weakness, particularly in the US, after a surge over the course of the past 2 or 3 years where we haven't really seen much of a pullback. And as I'm sitting here, we're still above the 200-day moving average. We've bounced off it for the third day in a row on the S&P 500 and the Nasdaq, and we haven't traded below it. What I would say, though, is the last time we traded below the 200-day moving average, and I know I like my crayons, and I know you like to take the mickey out of me.
You know what? Actually, I'm not going to, because moving averages are about the only piece of technical analysis that I think has any value.
Okay, well, that's good to know. So the last time we were below the 200-day moving average was in November 2023, November 2023. And when we did break below it, we were only below it for about 4 or 5 weeks before we broke above it. And the last time we were below it for any length of time was back in 2022, when the S&P dropped all the way down to 3,500. And since then, it's not quite doubled, but it's come a long way. So we've gone from 3,500 to 6,100 without really that much of a pullback. So
I think the last point I would make on this, because we probably should move on in a second, is I think that a decent chunk of what we have seen in the equity complex over the last fortnight is what I would call a rotation. It's people coming out of tech and going into more defensive sectors. It's people coming out. No pun intended. Although that has also happened. It's people coming out of the United States and into Europe and into Asia. You look at something like the Hang Seng as ripped higher. So I think there's also an important bit of context where you say, for a lot of participants, their actual risk allocations probably haven't changed much. It's just the geographies and the sectors to which they are exposed has spun around. If we were to get a further softening in data, or if we were to get an even greater degree of uncertainty, that's when you probably start to see an even more significant move to outright de-risking as opposed to just moving the chess pieces around.
And we're not there yet.
No, we're not there yet.
No, and there is other welcome news. Crude oil prices below $70 a barrel. So Indeed. That's going to be good news for motorists at the petrol pump, because it will certainly make filling your car up, your petrol car, your ICE car, that much more affordable, and certainly will mean that electric cars will be much more expensive. So,
yes.
I mean, as I say, that's good news, I think, in the context, because of obviously OPEC increasing supply from April.
Yes, and the other thing, of course, is sterling has rallied quite considerably. I mean, cable very briefly poking its head north of 128 earlier in the week. And
129 now.
Oh, yes, we are. Sorry, I was literally just calling that up as I spoke. So again, that will help, to a degree at least, eliminate a small chunk of upside inflation risk.
Yeah, absolutely. As I say, a stronger pound is always good for the inflation numbers, because it essentially dilutes the amount of the amount of inflation that we import. Easy for me to say. I think we've probably done this topic to death. Hopefully, you guys have gained some insight into it. Obviously, we do welcome questions.
Absolutely.
about the topics that we discuss.
And actually, not only welcome questions, but also if you've got an opposing view, then please let us know. We want to hear it. We want to test our own assumptions.
Well, I mean, we do agree on a lot of things, Michael, but there are also things that we don't agree on. But I have to say, I think your 110 euro dollar call now is looking pretty much on the money. Probably not for the reasons you thought.
No, absolutely not. I've got to admit that it's one of those where you do often get times in this job where you make a market call and then you do actually see it come to fruition, but for a completely different narrative than you'd predicted, and also much sooner. I don't think anyone on the sell side had euro dollar trading within two big figures of 110 on the 6th of March.
I didn't.
And no, nor did I, and I was the one who was bullish on it. But yeah, here we are, and it's all part of that. I think the story has become more positive for the euro, but also it's a huge bout of dollar weakness that's really driven that, of course.
I just think it's a pity that the reason that the euro prospects are potentially more positive is essentially because Trump has basically held a gun to Europe's head and said, "You got to spend more on defence."
Yeah,
it shouldn't take something like that to do what really should have been done back in 2014 when Russia invaded Crimea.
Yeah,
that was the warning shot, but whatever. Anyway, so let's have a quick look back at those defence calls that we made, and particularly Rolls-Royce. I want to talk about Rolls-Royce simply on the basis of the fact they basically released their full year numbers. I think the week that we took off, and the share price has just gone on an absolute tear. It's really strong set of numbers. They upgraded their guidance. Dividends back with a vengeance. And I think the only weak point was new markets, single modular reactors. And I think if that takes off, which I think it needs to, and I don't know why the UK government are dragging on it, because Rolls-Royce have got the skills. Single modular reactors based on their nuclear submarine technology. As I say, they've won a new 8-year submarine contract from the MOD. So why wouldn't you go local? Boost British jobs.
Absolutely. Again, there's a hell of a lot to like about Rolls-Royce. It's nice to have a homegrown success story, and the turnaround there continues. Reinstating the dividend, as you correctly predicted, is also a positive sign. And I did do this for a bit of fun, and it was a bit tongue in cheek, because these sort of charts where you compare relative performance of different assets, they basically hinge on the start date. But over the last 12 months, Rolls-Royce is up 110%, Nvidia's up 30%. And Nvidia take all the limelight, and Rolls-Royce has done 3 times as well. Yeah.
And yes, it's true. The reason Rolls-Royce has done so well is because obviously civil aviation air traffic has basically recovered to I think 109% of the levels it was in 2019, pre-pandemic. But nonetheless, we've seen a series of decent numbers from the carriers as well. IAG, British Airways, posted some fairly solid numbers. Today, Air France KLM shares are up 20-odd%, again, on the back of a strong Q4 and full-year numbers. So, and Lufthansa has also posted a decent set of numbers. So it suggests to me that the aviation sector is doing reasonably well.
Yeah, and of course, at what would typically be considered a relative quieter time of year.
But also, their share prices are low relative to where they were 5-10 years ago.
Yeah, when you look at what they're doing in terms of traffic volumes and all the other metrics, you would say that those shares are probably trading at a bit of a discount to where they should be, across the sector, to be honest.
Similar to what I was saying about Lloyd's, I think, a few weeks ago.
Yes, indeed.
And look where they are now.
Yeah, no, absolutely.
Not near £1 yet, but certainly they're above that. They're above 70p now.
They're on the way.
They're on the way. So I think again, it will hinge. I think on, as with everything, on how strong the economy is going forward. Banks, HSBC's down heavily today. I think that one of the reasons for that is because it's just gone ex-div, so don't read too much into that.
Yeah, they did today. Yeah.
Yeah, so that's probably why. And then ITV today posted some fairly solid full-year numbers as well. I'm not going to get too excited about them simply on the basis they've traded between 70 and 80p for the past 3 months. But they do appear to be doing much better than they were a year ago. And yet their share price is down from the peaks that we saw in the middle of last year when it was around about 85p. And with a dividend yield of around 6.5%, maybe they're worth a look. But again, very much depends not only on their advertising market and their ITVX streaming numbers, but on the performance of ITV Studios, which was a standout and posted record profits, even despite the writers and actors strike, which basically cut their revenue by about 3% for the year.
Yeah. I've got to be honest, I haven't actually looked at those in particularly much detail,
No,
but
that's fine.
your summation there seems to be very comprehensive anyway.
No. And as I say, we talked about Nvidia, blowout set of numbers in Q4. Q4 revenue, $39.3 billion, well above expectations of 37.5.
Isn't it?
12% increase on Q3, 78% increase over the same quarter a year ago. Data center made up 35.6 billion of that 39.3 billion number. So obviously that's AI. And full year revenue rose to a record of $130.5 billion, 130.5, up 114%. Q1 revenue forecast, 43 billion plus or minus 2%. Yet the shares have been absolutely larruped because they cut their margin from 75% to 70.6 to 71.2. Shock horror.
Yeah,
I mean, can't please some people, but I think there's a tariff story involved in this because obviously they do an awful lot of business with Taiwan semiconductors, and perhaps they could get caught up in the tariff war, and it could shave their margins even harder.
Yeah, there is definitely a tariff story. There's also a sort of broader geopolitical proxy story, effectively, whereby Trump is increasingly looking at chip exports and all the rest of it.
Yeah.
But if you look at the numbers in isolation, they're about as good as anyone could have asked for, to be honest. I mean, this is a company that is clearly the market leader and the dominant force in its sector. They are delivering incredibly impressive revenue growth. If anyone out there is complaining about a 70% plus margin, then give your head a wobble, because yes, the margins are tightening, but we always knew they were going to. It's not sustainable to operate at 75, 80% forever.
In the same way that Tesla was operating on 40% margins in the early days, and now is operating in margins of around about 25, 30%.
Exactly. That's just natural as the company and as the sector mature. I think fundamentally, you couldn't really have asked for a better set of figures. And, yes, it's obviously the other issue is that the prevailing market sentiment has gone from risk on to risk off very, very quickly, with their earnings slap bang in the middle of that. So that won't have helped at all. But assuming that all of this, blows over as you would expect it to, there's certainly nothing in there that makes Nvidia a screaming sell or anything like that.
No, there isn't. But it's about perception as opposed to reality. And the reality is that Nvidia's current valuation reflective of the revenue numbers that they're posting and the fact that their margins are likely to go down. Now, as long as the market believes that it is, it will continue to go up, whether or not it's reflective or not. Once the market sentiment shifts in the other direction, even though we know, and I know and you know, that those margins are going to shrink, the market will only decide that it thinks they're too expensive when it decides that it thinks it's too expensive.
Yes, at which point you're going to know about it pretty quickly.
Yeah, exactly. So for me, I'm looking at Nvidia, and I'm looking at the share price now when it's below $120. Back in August 2024, it was below $100. I think if we go below $100, you could get a rinse out.
Yeah, and that is a very, very important risk that's worth flagging. And I think the other thing, you think about Nvidia, there is probably a lot of relatively weak positioning in the name. Yeah. And also you think Nvidia is effectively the bellwether for chip makers across the board. So if you do see Nvidia start to roll over, you probably see the sector at large roll over. And of course, given the huge concentration that has in the broader market, you probably see the benchmark indices take a bit of a lurch lower on the back of that as well.
Yeah, particularly the Nasdaq.
Yes,
So
of course.
just be aware that Nvidia $100. I think that's the level that I'm looking at. Both moving averages, the 50 and the 200-day, are starting to roll over. The peaks are getting lower, the lows are getting lower. So there is signs of a potential correction in the offing. Whether or not we're there yet, I don't know. But I'm certainly cautious about Nvidia where we are at the moment.
Yeah.
That's not to say that I'd be bailing out of it, but I'd certainly be aware or looking for a potential break to the downside.
No, agreed.
Okay, so I mean, we've talked an awful lot about this week and last week. We haven't really talked about next week.
No,
and
we probably should, really.
And the reason for that is there's not really that much out. What we do have out is US CPI for February. Now, obviously, we saw that go US inflation edge up to 3% in January, which I think is probably prompted the Fed to stay on pause at its January meeting. And now you've got the potential, or the market's pricing, the prospect that maybe we only see another one more rate cut this year, or perhaps not even one more rate cut. I think much will hinge on what happens over the course of the next 4 or 5 weeks.
Yeah, absolutely. I mean, in many ways, it does sound strange to be saying this, but I think economic data is, to some extent at least, taking a back seat at the moment, because everyone is talking about the political side of things, what's Trump going to do next, all the rest of it, et cetera, et cetera, et cetera. It's kind of at the point where obviously we care about the data, but it's not necessarily the main market mover. And in many ways, I don't even think it will be the main determinant of Fed policy, because there is just so much for them to be watching. The one thing I would say, though, and I think, again, this could age terribly if you listen to this after the payrolls number, but the market reaction to US data over the last couple of weeks has been interesting, because we've seen this really brutal risk aversion on any soft data, on any downside surprises, but we haven't seen a significant rally on upside surprises. So the ISM services figure actually came in quite a lot better than expected on Wednesday when that data came out, and the market just kind of shrugged its shoulders. And I think that's very telling about where sentiment is and how downbeat people are on the state of the economy at the moment.
But also, I think maybe the Fed's mindset may well shift to the employment component, particularly if the jobs market does start to weaken, and they'll pay less attention to inflation. So it's that tightrope that they have to walk because of the joint mandate that they have, or the dual mandate that they have.
You're spot on, and I think it will get to a stage potentially where you have PCE at 2.6, 2.5%, and the Fed kind of go, that's close enough to 2 for us to do another rate cut because we need to preserve the labour market. And there will be plenty out there that, as soon as Powell does that, start screaming from the rooftops about inflation making resurgence and all the rest of it. But as you say, it's the dual mandate. You've got to balance those risks somehow.
Okay, what else have we got? Well, next week we've got monthly GDP from the UK. Now, we got a pleasant surprise at the end of last year in December, because we got a 0.4% monthly expansion, which helped avert a decline in fourth quarter GDP. So January GDP is going to be interesting. But what was notable, I think, about the December numbers, and I've written it down in my Substack for this week, is that hospitality did well, with accommodation and food services rising 0.4%. But a large part of the reason for that is obviously, I think, in December, pre-Christmas, what have you, people going out, exactly. People go out. The bigger question for me is, with all these tax changes, national insurance, business rates, and new taxes coming in April, whether or not that can be sustained. And so I think we're going to slow for January. The bigger question is, by how much?
Yeah, I'd agree with that. It wouldn't be. I mean, the big surprise was that the economy grew by 0.4% at the back end of last year. The big surprise won't be that we see some of that given back in January. It's natural that belts are tightened after Christmas. We see that pretty much every year. The other point I would make on GDP is that the bulk of the growth that we saw at the back end of last year, and there was a lot of growth, but there was some, was due to government spending.
Yeah.
The private sector was at best stagnating, and I think that's the real concern, is that even if you see a chunky increase in GDP at the headline level, it's effectively papering over the cracks of an economy that is faltering, a labour market that is weakening, and of course the degree of uncertainty on the outlook, where we've got the NI changes coming in at the start of April. That's probably only going to make things worse.
Well, on a GDP per capita basis, we're actually already in recession.
Yes, we are.
So, because that's the economic output per person. So while the actual physical output will be higher because there's more people, on a per person basis, it's actually lower.
Yes.
And obviously that is a worry.
And that's the stat that matters, but that doesn't get enough attention.
It's easier to ignore.
Yeah.
We've also got a Bank of Canada rate decision.
God, I would not want to be in their shoes at the moment.
No, not with all the tariff stocks that's going on. I mean, to be fair, they did cut rates at their last meeting by 25 basis points to 3%. So I'm thinking they're probably going to sit on their hands on this one. I don't think they've got an election coming up as well. So there's a political aspect as well. I don't know when that is, because obviously Trudeau's...
there's no date yet.
No, there isn't. So it'll be interesting to see what they say about what's going on. I think in terms of taking the temperature from a central bank point of view, that's essentially in the eye of the storm, so to speak, the tariff storm. So
no, absolutely. I don't think they'll do anything either, but I wouldn't rule out a rate cut. The issue is, we're sat here talking about the tariffs now, and literally while we've been speaking, Howard Lutnick has been talking about there might be some more exemptions. So it's hard enough for us to make a podcast and keep up with everything. If you're trying to set interest rates as well, I think the best course of action for them might well be to just say, we'll do nothing for now, but if X, Y, Z happens, if the economy softens, we're ready to do whatever it takes, to coin Draghi's phrase, and then potentially deliver a cut at the April or the May meeting, depending on when that is. But given what's going on, I think they might have the toughest job of any G10 central bank at the moment. Yeah.
Okay, so we're going to finish up. We've got full year numbers next week from Persimmon, the UK house builder. Not really expected to see too much in the way of surprises there. 2 months ago they issued a trading statement back in January, which has pretty much set these numbers up. We've got Deliveroo's full year numbers. Again, full year revenue is expected to increase by 2% to 2.07 billion. Gross transactional value growth of 6%. So again, delivery companies doing well. But when you think about Deliveroo, and it IPO'd at 390p, it's now 125p. So
yes,
I think that probably says everything you need to know about the London IPO market, but hey-ho. And then Balfour Beatty. Now, this week, the shares of Balfour Beatty saw a little bit of a tick lower because the architect of its recovery, CEO Leo Quinn, announced he's stepping down. Now, a little bit of a history lesson. You can read about it on my Substack, but when he took over, there was a real crisis in the UK construction sector. Anyone who remembers Carillion in 2017, the collapse of that, and Leo Quinn took over. Balfour Beatty nearly went under as well in 2014. He basically turned the business around single-handedly and turned it. And again, if you wanted to do your comparison for Rolls-Royce and Nvidia, do Balfour Beatty and Nvidia over the course of the last 2 or 3 years. And I think the comparisons will be very, very good because he focused on high margin work, only doing work that basically fitted a certain criteria. A big infrastructure provider in the US, in Asia, and in the UK. And he prioritised that work. Share prices at record highs. So it'll be interesting to see how he frames the new CEO who's going to take over in September, and whether or not they upgrade their guidance not only for revenue, but also cash flow as well, because they've gone from being in massive debt to running a cash surplus.
Yes. No, I think that is going to be interesting, and certainly could spice up what is actually quite a quiet reporting slate next week.
Yeah, it is. There's not much there. As I say, there's Deliveroo, Domino's Pizza, Persimmon, and in the US you've got Williams Sonoma, who basically own the Pottery Barn brands and the West Elm brands, which tend to be fairly sort of middle class, not IKEA, but above that, sort of furniture type stores. And then you've got Dollar Tree, which is sort of, I suppose, the equivalent here would be Poundland. So
yes,
again, that gives us a good insight into the US consumer at a slightly, lower tier level, if you like. So that's it, really, I think, for next week. Any questions on anything that we've discussed? More than happy to try and answer them for you. But
yes.
We'll hopefully be back. Well, we will be back. So,
I was going to say, what do you think is going to happen to us?
Well, we disappeared last week, didn't we?
We did, but we will be back next
various
week.
Technical problems. So, yeah, I mean, we'll be back same time next week, where hopefully we'll be able to give you a much better steer on what markets are going to be doing over the course of the next few weeks. But ultimately, I think at the moment, we're seeing an awful lot of choppiness, an awful lot of volatility, but we're not out of the trading ranges that we've been in for the course of the past 6 months. And I think if you hold on to anything, hold on to that.
Absolutely.
Okay. All right. Well, that's it. So we'll see you all. We will both see you all same time, same place next week.
Bye-bye.